We could get sucked into Ukraine, where um, Russia and NATO start shooting at each other, and then we're kind of sort of in a shooting war against nuclear power. We're not past that. The Japanese economy fall into some kind of a crisis, and nobody expects that right now because people have been talking about it for a decade and it's never happened. But let it happen. And that's a really big deal for us too, because Japan owns a massive amount of US Treasury bonds. So were they to have to start dumping those bonds, that would spike. Our Eurozone could have a crisis that leads to either the breakdown of that currency and the Eurozone members going back to their old currencies, or some kind of a bond market crisis that there's a lot of Euro debt existing in the world. So if that debt starts to default in one way or another, there's a lot of potential bankruptcies that flow from that could impact the U.S. What happens if China or the CIA gets a superhuman AI? It just develops on its own because they give it the ability to improve itself, and then it just launches and takes off and turns into something that is neither understandable nor controllable.
You're watching CapitalCosm. It is July 28th, 2025, and my guest today is none other than John Rubino. John, thank you so much for coming back on the show, my friend.
Hey, Danny. Thanks for having me back.
Always a pleasure. Always a pleasure. Let's go ahead and dive right in here, John. For you right now, what's taking up your main focus? If you had to pick one thing that was sticking out on your radar screen, one thing that should be sticking out on the radar screen of the average investor out there, the average stacker out there, what would that one thing be?
There are so many things going on right now that are, drawing attention, or that should be drawing attention, because the economy, obviously, we've got all kinds of weird things going on between the trade wars on the one hand and a lot of indicators of an upcoming recession on the other hand. And equities are set up for a crash based on history. Every time we've been at these valuation levels, the next couple of years have been brutal. And then geopolitics is still really unsettled. And these multiple scandals are potentially big deals for the financial markets, just because when politics is unsettled, so is finance usually. But the whole Epstein thing, followed by the Trump-Russia collusion thing, these are all really big deals. But as a gold bug, I'm still paying attention to gold and silver more than anything else. And right now, gold is consolidating, which means it's just trading back and forth in a really narrow pattern as it figures out what to do. And that's not a surprise at all, because it had a phenomenal 2-year run. It's up $1,000 an ounce in just the past 12 months, which means there are a lot of people with profits to take in precious metals right now, especially gold. So they're selling, but new people are coming in and buying, and you get these up and down days that don't really amount to much. And that's basically a healthy thing in a bull market. You've got to have consolidation periods while the weak hands hand off their assets to the strong hands, who aren't going to sell at this price for any reason. And then you can resume the upward momentum again. So that's probably what's going to happen with gold. But meanwhile, silver and platinum are outperforming gold, which is a really good sign, because that means the commodities bull market is broadening out. You don't just have one or two things leading the way and everything else lagging. So basically, this is a healthy environment for commodities in general, and precious metals in particular. So I'm basically, despite all the crazy stuff going on, I'm pretty happy with the central thing that I pay attention to. But all of this other stuff could change that on a dime. There are all kinds of things that could happen that would go from being ominous to terrifying in a heartbeat. So we can go through that list if you feel like it.
Yeah, but before we get into that, let's go ahead and take it back to gold, because you did mention it. This is the gold chart. This goes all the way back just about a decade or so. And you can see the momentous ride we've been on since early 2023. If you do look at this consolidation period here, let's go ahead and zoom in on it. It really began in April of 2025, and it's been consolidating since. But the kicker is that if you look at the previous consolidation period, this time last year, April 2024, again, you had a similar consolidation. and then it finally took off around, what was it, July, and then August. Sometime in July and August, you saw the subsequent leg of that consolidation. And so we, in the gold market and the gold price action, we do see these summer doldrums, I believe is what they call them, when traders and hedge fund managers, they sell in May and go away. That's the old saying, and they come back in the autumn to resume trading.
Yeah, the seasonality part of this, actually, gold has kind of blown through its seasonally weak period a couple times, so people are paying less attention to it. But historically, yeah, it usually you do want to sell or at least stop buying in late spring, early summer, and there are good reasons for that, especially in Asia. The buying tends to pick up in anticipation of spring weddings when a lot of gold jewelry is given and silver jewelry. And so the buying kind of peters out after that, after the spring buying is done. And so you get kind of summer doldrums, and you frequently get lower prices for gold and silver. I know I've been burned by that a few times where I thought, big spring, maybe seasonality doesn't matter anymore. Let me keep buying. And then by July, I wish I had just paid attention to seasonality. So yeah, there's that too for precious metals. And the chart that you've got up is a very healthy chart. That's a bull market chart right there. And from a technical standpoint, that won't change until when and if gold pierces the lower band of its upwardly sloping trading range. So let it drop by, I want to say 15 or 20% from where it is right now. And then you would get a technical signal that maybe the bull market is broken and other things are going to happen. But there's nothing like that on this chart so far. And there are good fundamental reasons for precious metals to still be rising. And this might be a good time to segue over into the whole Fed debate that's going on right now, where Trump, who is an easy money guy, wants lower interest rates. He's been buying real estate for 50 years, and cheap money is the way you do that. So for him, lower interest rates are just a no-brainer, especially if you have the power to make them happen. You obviously make them happen. So he's bullying the Fed right now in various ways and demanding that they lower interest rates, and he'll eventually get his way. Either the Fed will capitulate and start cutting, or the Fed governors will leave and Trump will put his people in who will just immediately lower interest rates to back to zero or someplace like that. So that's a very positive thing for precious metals. If you've got lower interest rates in the not too distant future, then that's the kind of environment that you like to see when you're an inflation hedge. If somebody's buying gold and silver because they're afraid that the dollar is going to be inflated away, well, let us move interest rates down to zero again while running massive deficits. And you've got the environment where the dollar is being inflated away, and you want to be in things that will protect you from that. So that's probably a 50-50 bet right now for our future of the next couple of years, where we're back to aggressively devaluing the dollar, and the things that benefit, the real things, are doing very well.
Yeah, I want to point your attention to this Fed funds rate chart, which is down here in blue at the bottom pane. You'll notice that once we cut interest rates about 100 basis points, this is back in August of 2024, and the cuts, we saw cuts all the way out until the end of the year. The 10-year yield, which is portrayed here at the top, rose from 3.69 all the way up until 4.62. So it appears that the short end of the yield curve, i.e. the Fed funds rate, was having an inverse effect on the 10-year. How do we make sense of that?
Well, that means the bond market is worried about what falling interest rates would do to the inflation rate and to bond valuations, and they're demanding a higher rate of return when they invest in bonds. When you invest in a bond, you basically lend money to somebody who promises to pay it back to you in a future date, while paying a little bit of interest at a time, on a monthly basis or whatever. And if you're worried about the future, you're less likely to lend in that way, by buying bonds, and you want a higher interest rate to make it worth your while. So that's what the bond market is saying. They're saying, well, okay, if you're going to be reckless with monetary policy, then we're not going to go along with this. We're not going to accept lower and lower interest rates just because you tell us to. You got to behave in a way that makes us comfortable with the inflation rate of, say, 2 years to 5 years hence. And the bond market is not comfortable right now, and that's just not just in the US. Lots of other countries' bond markets, notably Japan's, are having the same kind of behavior where, the government may want lower interest rates, and start lowering interest rates in the short end of the spectrum, but the bond markets don't cooperate and long-term rates go up. Now, this becomes a big problem if interest rates go up too much, because long-term rates will choke off economic growth if they rise beyond a certain point. Mortgages, for instance, key off of the 10-year treasury yield. So let the 10-year treasury yield rise from here, and that means mortgages go up. It also means car loan rates go up. So you can choke off economic growth if long-term rates go up too much. And you can also bankrupt governments who have to pay interest on their debt and who are accumulating a lot of debt. The US has $1.5 trillion in interest expense already per year, and we have to borrow that, which raises the deficit in the future, and debt piles up even more, and our interest, we have that kind of a death spiral thing going on if we can't lower interest rates across the yield curve. So this is a big dilemma and a potentially big crisis if it doesn't work. If easing doesn't work, in other words, if it makes long-term interest rates go up, then we're out of tools. There's no way to fix an over-indebted financial system if you can't inflate away the debt. And that's a very real possibility in our future. If we cannot liquefy the system in a way that makes long-term interest rates lower, dramatically lower, then we're basically we're done, as a financial system. And I think that day is out there waiting to happen. There's always going to be a time. There will eventually be a time when the tools for inflating away debt no longer work, and the whole fiat currency experiment just breaks. And it feels to me like we're close to that, because government interest costs are going up dramatically while long-term rates are not falling. So that's the beginning of that kind of a process. So watch it. And if it doesn't change over the next, say, 6 months to a year, then that's a sign that the experiment is ending, and something else has to be put in its place. And the governments of the world either have to choose to do it right away preemptively, or have to wait for a gigantic crisis to come when they're forced to do it. So either way, you get a monetary reset out there. And it's just, how big is the crisis before it happens?
Yeah, and it would inevitably lead to a debt default, would it not? If they did try to go with yield curve control, they tried to keep the yield at an artificially low level while the value of the debt is relatively down as well. I mean, wouldn't that precipitate foreign buyers and any buyer of US debt to just say, I'm not getting a good yield on this debt, and it's also not in high value? Why would I own it? Wouldn't they just dump all our debt and create some
Yeah.
sort of debt spiral?
Well, that's kind of what's happening. Bond buyers and bond owners are not impressed with the US yield right now, or the Japanese yield, or a lot of European yields. And they're just not interested in buying that paper. And in the case of countries and other entities that own a lot of treasury bonds, they're not really that excited about holding the bonds that they have. So yeah, you get a bond crisis when something like that happens and spins out of control. So we won't default in the sense that we're not going to stop paying interest on our debts because we have a printing press. We can create all the currency we need to pay the interest, but we can't control the cost of taking on new debt. In other words, if interest rates go up, that means we have to pay more in order to borrow money. And that's the part that breaks the financial system. If the cost of borrowing and maintaining your debt starts to rise in an uncontrollable way, in a disorderly way, then you're basically out of tools, And when people figure out that you have no fix for this, then you get the crack up boom. The Austrian School of Economics event where people just give up on a currency because they recognize that the government has no choice but to inflate that currency away. So they just dump it by buying real stuff whenever they get money. And then that means you have hyperinflation in real assets because everybody's trying to dump their currency by buying real stuff. And the system just breaks. This has happened many times in human history. But what's different this time is that it's happening globally. Usually it was one country in an otherwise sound money world screwing up its currency and having something like a crack up boom happen. But now we're looking at it globally, where most of the big countries are in some version of this fix and are heading for basically the same place where their currencies start falling rapidly towards their intrinsic value of zero. And so we've never seen this happen on a global scale before. So from the standpoint of a finance nerd, this is fascinating. We've never seen this kind of history take place. They'll be writing about this, assuming there are historians still writing about history 50 years from now. They'll be writing about this period. And so we get to live through it, which is horrifying for 99% of the population, and interesting and potentially very profitable for the gold bugs and the libertarian economics people out there, because they tend to understand what's happening and are able to prepare for it. So, that's kind of your job and my job, is to convince a growing number of people that this is what's coming, and talk about how you prepare yourself for it.
John, earlier on, you mentioned that the markets were overvalued by many metrics out there. And I want to tie this into what you just said right now regarding the crack up boom. If you look at the crack up booms in various hyperinflationary scenarios in the past, the stock market also made new nominal highs. So I want to take us to our current stock market here. And now, yes, we are seeing prices break out to, or valuations break out to all-time highs when it comes to the S&P priced in dollars. But if you look at this thing priced in gold, for example, this is the S&P priced in gold. I mean, we are just bouncing back actually from a support line here that's been built up over the last 5 years or so. So when you price the S&P as in something as tangible as gold, that's not a moving target like fiat dollars, it's nowhere near an all-time high. We actually had the last time we had an all-time high was in 2000. Now, if you want to play around with this ratio, you can also look at M2 money supply and control for the amount of money sloshing around into the system. Looks a little better for the S&P, but it's still a little distance away from the previous all-time high back in 2000 as well. Could we be in the midst of a crack up boom right now, given the fact that the stock market's not looking, it's just moving forward, not looking back? Yes, it's breaking records on a nominal basis, but when you look at it from the perspective of being priced in gold, being priced in M2 money supply, being priced in, we can even look at it in terms of the US CPI. Now it is at an all-time high when you look at it from the US CPI standpoint, but 2 out of 3 metrics that we just looked at here, it's not at an all-time high.
Yeah, well, these charts are a good example of how inflation distorts financial reality, because it makes it look like things are going up when, in terms of real money like gold, they actually aren't going up at all. They're not being more valuable. And yeah, we could easily be in the early stages of a crack up boom, because you're seeing real things like gold and silver, and still houses, amazingly, although that might be ending, because that's a wildly overvalued market. But a lot of commodities are going up right now because they're real things that you can't inflate away. And the stock market right now is a very narrow market. It's being led by just a relative handful of companies that seem bulletproof. So capital is flowing into things that look like they're going to continue to succeed in an accelerating way, like Nvidia or something like that. But the vast bulk of the stock market right now isn't rocking like that. They're not looking like the Nasdaq, the S&P 500, although it's doing okay too. But it's being pulled along by this handful of really powerful tech stocks mainly, and that's also an indicator that you've got a correction or a crash coming. So yeah, we could look back on this period, basically the period when gold broke through $2,000 an ounce and then really took off. We could look back and say, okay, that's where it began. Because if we keep up doing what we're doing right now, if we continue with the current trends, you do get to a period where the dollar has crashed and real assets have basically exploded upward parabolically. We're in the early stages of something like that. And if what we're doing continues, then we'll get there. Yeah. So it could be that this is the beginning of a crack up boom or a currency death spiral or whatever term you want to use for this. And I think when we look back on this period, gold soaring and the interest costs of a lot of big governments also soaring at the same time could have been the thing that we should have heeded at the time. That could have been the signal, looking back, for the beginning of the end of the fiat currency experiment. So, you never know until after the fact where something began, but it could easily have already begun. And so it could give us 3 to 5 years of financial chaos before we resolve it in some way.
Looking to invest in silver or create something unique? Go to firstmint.com and use the promo code CAPC. First Mint offers premium 0.999 plus silver bars and coins, perfect for stacking or gifting. Plus, they specialize in custom minting for businesses and events. Great for celebrating milestones or promoting your brand. For quality silver and trusted service, visit firstmint.com and use promo code CAPC and make your mark today. Once again, that's firstmint.com, promo code CAPC. And while you're there, check out this great deal ongoing now. John, you look at the last big run in gold that we had. I'm not talking about 2011. I'm talking about 2020, when you saw gold rise and make all-time highs at around $2,100 or so from the lows of the COVID crash. And a year after that, we started seeing price inflation reflected in the CPI. Now, the price of gold has been rising for 18 months now, 19 months or so. Should we anticipate that as a precursor for a subsequent wave of inflation? Is gold essentially the leading indicator in regards to inflation? And if so, does that not imply that we should anticipate a secondary wave of inflation here as well?
It's hard to say because there are so many cross currents right now. Because you showed M2, so the money supply is starting to increase again.
Mm-hmm.
Gold is up, which is an indicator that people are worried about inflation and financial instability. Bond yields are up, which is a sign that the bond market is worried about rising prices in the future. So there are indicators that we've got a burst of inflation coming, but at the same time, you've got a lot of deflationary indicators out there. Consumers just don't have much money left, and American consumers in particular are starting to put day-to-day life on credit cards, which is a sign that we're basically towards the end of that particular trend, because you can't really function when you're carrying balances on credit cards that are charging you 25% a year. That's a sign that you're going bankrupt, not that you're going to embark on a new burst of consumer spending. So, it's really hard to say, because a stock market correction, like an equities bear market, is deflationary, and consumers pulling back because they've got too much debt, that's deflationary. So I don't know. I think there's a case to be made for carrying some stock market shorts right now in anticipation of maybe a deflationary event at some point. Like if interest rates spike, long-term interest rates, that's a very deflationary event that would be pretty hard for the rest of the financial market to ignore. So, I've got some NASDAQ put options, some long dated ones that I've got for insurance against a deflationary event. And then, of course, a lot of precious metals and related things that are bets on continuing inflation. But I don't think we can know for sure which of those we're going to see in the next year. Either one is completely feasible given all the stuff that's going on out there. And then we've got all the political and geopolitical stuff that kind of right now would be classed as gray swans, stuff that could happen. We could see it maybe happening, but it's not yet. But if it happens, it could happen suddenly and scare everybody. So, there's a potential mess, multiple potential messes out there of various kinds. And I think all you can do is insure against the seemingly the most likely ones, and then hope that your insurance pays off enough to offset the damage that the event does, whatever it does to you.
What are those gray swans that you alluded to? You kind of alluded to at the start of the show as well. Do you mind using
Yeah,
this term?
sure.
Do you mind unpacking it?
Yeah, well, gray swan is a black swan is something that just comes out of nowhere and is potentially devastating. Something that you're not really expecting and you're not even really conceiving of. Gray swan is something you can totally conceive of, but you still don't expect it in the moment. And there are a lot more of them than there are black swans, obviously. But we could get sucked into Ukraine, where Russia and NATO start shooting at each other, and then we're kind of sort of in a shooting war against nuclear power. We're not past that yet. It's not as big a deal as it was under the Biden administration, where we seem to be actively trying to make that happen. Now, Trump doesn't want it to happen, but the other parties aren't really cooperating, and so something like that, which I don't expect to happen, but could easily happen with all the parts that are on the game board right now. That would be horrendous for the financial markets. If two nuclear powers start killing each other's soldiers, and then a financial crisis in some other country. We're not paying that much attention to Japan or Germany or places like that, but they're screwing up their culture. Well, in the case of Germany, their culture as well as their finances. And Japan, they're screwing up their finances monumentally. The Japanese government has more debt per capita than any other country in human history, I think. And their interest rates at the long end of the yield curve are starting to go up, even though the government doesn't want them to go up, and the government owns like half the bond market already. And so it's not clear that there's an easy fix for Japan. They have some serious demographic issues too. But let the Japanese economy fall into some kind of a crisis. And nobody expects that right now because people have been talking about it for a decade and it's never happened, but let it happen. And that's a really big deal for us too, because Japan owns a massive amount of US Treasury bonds. So were they to have to start dumping those bonds, that would spike our interest rates. There's something like that could happen with pieces of the puzzle that are already out there. You can see them, see how they fit together. And you just don't expect it to happen right away, but it could happen. So that's the kind of thing that could just blow up the U.S. stock market and maybe the bond markets too. And Europe is such a mess right now. They're committing cultural suicide. There isn't a day goes by when there aren't more videos of really authoritarian stuff happening over there. At the same time, their economies are extremely weak. They're not keeping up with the rest of the developed world. And so, the Eurozone could have a crisis that leads to either the breakdown of that currency and the Eurozone members going back to their old currencies, or some kind of a bond market crisis that there's a lot of Euro debt existing in the world. So if that debt starts to default in one way or another, there's a lot of potential bankruptcies that flow from that could impact the U.S. too. So, yeah, stuff like that. It could happen. Probably the odds aren't good that they will happen, but there's enough of them out there that the odds of one of them happening is actually pretty good right now. So, we'll see. All we can do, again, is diversify in preparation.
You know what, John? You just gave me an idea for a section of the show moving forward. So you mentioned the gray swans, right? Let's talk about if you were to choose something completely out of left field. We can even call it a black swan that no one's talking about, that no one sees coming, an event that would catch everyone off guard. What would that event be? Like if you had to just throw something in there that no one else is talking about, what would be your black swan event?
Well, one that nobody's talking, well, everybody's talking about AI, but they aren't talking about necessarily what would happen if somebody that is not good became the first to develop artificial general intelligence. In other words, a kind of superhuman artificial mind that can
AGI.
break any, AGI, sorry, they can break any kind of encryption, and that can basically just get in anywhere, and surveil anybody because we can't defend against it, or that can create weapons that are more advanced. There's all kinds of things something like that could do, and read science fiction novels and you see all the possibilities. Well, what happens if that happens? What happens if China or the CIA gets a superhuman AI? It just develops on its own because they give it the ability to improve itself, and then it just launches and takes off and turns into something that is neither understandable nor controllable. That's a civilization-ending event, possibly. And it doesn't seem like we're that far from something like that becoming conceivable. Right now, nobody has that capability, but there are also there are a lot of stories out there about AIs doing things with volition. In other words, you try to turn it off and it hides its code in a different system so it doesn't get turned off. That's what's happening right now. So, and AIs are also programming themselves, where they're learning and growing in ways that the original programmers don't necessarily understand. So we're not that far from kind of a hard launch of some kind of next generation AI. And were that to happen, that'd be a huge deal for the financial markets. Although, I wouldn't even venture a guess about how that would happen exactly, or what exactly would happen step by step. It's just the kind of thing you don't want to be vulnerable to if you can help it. And that again leads back to physical assets. You kind of want to own real stuff that has utility if the world's financial markets are on the verge of being hacked by something that nobody can understand or control. So if you've got a homestead, then super powerful AI is not going to affect, next year's corn crop or how your chickens are laying or anything. So you've still got assets that are understandable and not really at risk. So if you think something like that is about to happen, then you want to become a full-on prepper / survivalist immediately, right? You want to protect yourself in as many different ways as possible from the chaos that would ensue in the financial markets if AGI actually happened.
Yeah, with AI, right now, we're still at a point where the input data that these AI models are running off of are human derived. It's a human corpus, right? However, as time goes on and these AI models become more and more efficient, what you'll begin to notice is that the corpus, the input data that these AIs are referencing for their models, become previous AI output. So in effect, they begin to create this recursive effect where the AI is teaching its own self or its future iterations from its own output. That makes sense. And so that when that happens, it's completely unpredictable what transpires out of it. Does it just go insane? Because it's, a small error in output can yield massive changes. It's the butterfly effect. When you keep repeating it over and over and over again, that small differential between actual and estimated, or truth and falsehood, becomes big over time. And so it wouldn't be unsurprising to see AI essentially go mad over the fact that it's just being trained on bad data from its own self.
Yeah.
So great black swan there, John. Before we close out, you did mention the precious metals one more time. So this is another fun one. If you had to choose between the yellow metal, gold, or the two white metals, silver, platinum, which one do you anticipate having the greatest runway, the greatest upside, the greatest asymmetry from here on out?
Well, the way precious metals bull markets normally work is gold goes first, because that's the thing you get into when you really don't understand the whole concept of inflation hedges and real money and stuff like that. But you know, you've heard of gold and you know it goes up in those kinds of situations. So you buy that first. Excuse me. And so gold's price goes up. And eventually it gets to a point where you compare gold to silver, for instance, via the gold to silver ratio, which tracks the number of silver ounces it takes to buy an ounce of gold. And when that number gets huge, in other words, when it takes a lot of silver to buy an ounce of gold, and so for the price of a crew grand, you can get 70, 80, 90 ounces of silver. People start switching to silver at that time. And silver is this little tiny, thinly traded market. So it begins rising dramatically in percentage terms, and it outpaces gold for the rest of the precious metals bull market. So you get gold taking off first, then silver catching up to it, and then exceeding it in percentage increases. And the last year or two of a silver bull market is usually just straight up. It's just this crazy parabolic move when there's no silver left, and whoever's going to buy it has to pay whatever price the market is offering it at right now, and that means you're basically buying at the market in a very thinly traded market, so you're paying way up. So you basically want to own your silver before that happens. And 2 years ago would have been the best time to do it, but this is still a reasonably good time in terms of where silver might end up. Let's say gold keeps going up and we see $5,000 an ounce gold, which we totally can in the next few years with the forces at play right now. And then the gold to silver ratio goes to something like 50 because silver is going up faster than gold is. Then you get a really high price for silver. So triple digits is conceivable at that point. So yes, if you buy silver at $40 an ounce right now, it feels like a lot, but if it's going to go to $120 an ounce, you still triple your money and protect yourself along the way from all the chaos. So I think this is still a reasonable time to buy silver, and absolutely the silver miners. There just aren't very many of them. And once people start thinking in those terms, thinking, wow, my silver's way up, let me buy a miner because it'll go up even more than silver. And you just won't find that many silver miners available. And their prices will also go parabolic. So there's definitely a play out there. There are mining stocks right now that are reasonably priced given what might happen. Given a parabolic move in one of the metals, then the miners will just go crazy. So their current price compared to that speculative future price is super cheap. So I think that you don't necessarily want to buy the miners at the market right now, but get in using low ball bids. Say come in at 10% below today's price, and then hope that bid gets hit in the next correction, things like that, or sell put options as a way of getting into a mining stock cheaply. And always, if you find one you like, don't buy a lot up front, buy some, and then dollar cost average your way into the rest. So you want to try and get the best average price possible, and not be too overexcitable, because that's when you get burned. But just know that this is a trend that's in place, and just ride it by buying a little bit at a time and hoping that your average price ends up being really favorable at some point in the future.
All right. So silver it is. John, thank you so much for coming on the show, my friend. It's always a pleasure. It's always interesting having you on. Where can people find you if they want to hear and see more of your work?
Thanks, Danny. I'm at rubino.substack.com, and the newsletter I publish there is aimed at actionable advice for all the stuff we just talked about today.
Excellent. Well, we will have that link down below. So check it out, guys. Great Substack by John. Guys, if you enjoyed this podcast, drop us a like and comment "Go John Go" in the comment section. If you disagreed with anything, that's fine too. But let me know what you disagreed on and why you disagreed on it. I do, in fact, read the comments. And then finally, subscribe to the channel so you don't miss another episode, and to help us boost this content in the algorithm by liking it, subscribing to the channel, commenting down below. All of it goes a long way. So much appreciated for all of your help there. And if you'd like to take it a step further, then check out the Substack at capitalcosm.substack.com. Link is down below as well. So thanks for watching, guys, and I will see you later.